Right, just bear with me. It doesn't. There we go. We thought we would take you through quickly the Lancashire bond issue. Take through as a reminder some of the business case, where the agency is in relation to future bond issues, and then take you through some of the key features and changes around the UK MBA and a quick recap. Because it's a video call, if people could wait for questions at the end, that would be better, I think, partly because of the lag, and also as I'm presenting, I can't actually see any of the chat functions or anything, so it will make it very difficult for me to answer them. The bond issue, £350 million bond was issued on behalf of Lancashire County Council on the 5th of March. It was a 5-year floating rate note for those that haven't seen the details. What that means is the interest rate changes quarterly, and it's referenced to SONIA, which is the replacement for LIBOR. SONIA is, being polite and frank, a bit of an emerging beast at the moment. It is much more reliable than LIBOR, but there's not a great track record of it in terms of time, and lots of financial products are transitioning over. This did mean that Lancashire was actually one of the first to issue a floating rate note linked to SONIA. In fact, it's the first non-supranational issuer to issue in sterling. So it was quite a first, both for the agency and Lancashire. It's important to note that the bond itself does not fall within the proportional guarantee, which we'll come on to later. It is solely guaranteed by Lancashire. In terms of pricing, it was 0.8% over SONIA. So the gross savings at the time of the issue, bearing in mind there are some issue costs and things, it was 0.81% over the equivalent Pwb variable rate, which was the equivalent of 1.08% over the fixed rate, and that's Barclays' calculation, so they're fairly neutral on this one. The savings have actually increased over time. As of yesterday, the rate was 1.45% below the Pwb certainty rate, and if we'd issued that bond today, we'd have saved 1.12%. So it was actually a very good trade for Lancashire. In terms of the business case and where the agency was in the past, the arguments for the UK Missable Bonds Agency were largely set out in the revised business case a number of years ago. First and foremost, it was to protect councils from changes in the BWB, both the terms and conditions and the rate. Now, over time, those terms and conditions and rates, as we all know, have not changed to the council's advantage, they've changed against them. It's to provide fully transparent financing, reduce risky and excessive borrowing, tailor products to suit local authority needs, and generate economies of scale. Coming on to what's actually happened, PWB rates have increased. The future of the rate is uncertain, which I'll come on to later. The UK MBA has delivered savings. Lancashire will save somewhere between 15 and 20 million over the next 5 years through issuing the FRN. Some complex products are coming to the fore again. Most of us are aware of certain types of LIBO, but not all. There were types of loans and they were quite complicated. But we're seeing things like income strips, which are secured loans on property linked to inflation. Unless you've got a 50 to 60 year view of inflation, there's some risk there. Some councils, a few, have excessive and risky borrowing. There are alternative loan products out there that are often opaque or poor pricing. If you can't tell me what the interest rate is on, say, a private placement, and you can't tell other people, then it's not transparent and it's opaque. With the 50-year gilt rate where it is at the moment, as of this morning, it was 0.45%. The PWB margin actually quadruples the cost of borrowing at that maturity. It will vary depending on maturity, but that's the long end of the curve. Where we are in terms of future long-term bond issues. We've had discussions with a group of councils that have been ongoing for a few months now, and particularly around March. We have demand for the agency in really 3 buckets. Around about 10 years, which is always the long-term plan of the agency to issue its first bond there, 20 to 25 years, and 40 to 45 years. There's very few exceptions to that, if any, for what people have asked us for. We need clear demand in order to proceed with a particular bond issue, and we need specific maturities to be agreed with the borrowers. So whether it's 20 to 25 years or 40, 45, 43, we'll agree that with people who want to borrow in that bucket. What this actually means is we need 250 million demand for a given maturity. That's so we can issue a benchmark bond into the markets. In certain situations, we may get away with 200, but 250 is the target. We need to be certain that authorities will participate subject to rates being lower than those of the Public Works Loan Board. Obviously, the agency is not going to require somebody to borrow above the Pwb rate. That's silly and possibly ultra-vires anyway for a council to do that. So the confidence has to be based on commitments to participate in the bonds, approving the framework agreement, and asking the agency to begin its credit process on you as a borrower. And that's really to keep things moving and get them rolling. In terms of timescales, there's been a lot of misleading information around about the agency. Bonds will be placed within 8 weeks of benchmark demand being identified. Moody's needs round about 4 to 6 weeks for its credit work on the agency. Certainly on the early bond issues, Moody's will look at all the councils that are coming into the pool and do an informal credit assessment. It's important to stress that's not rating the council, nor will they be in contact with the council. They will do that in the background for the agency. It needs local authorities to make sure they meet their deadlines, for example, signing a framework agreement. As we all know, whether it's personal or professional, people do miss deadlines from time to time. Over time, the timescales will shorten. So the more confidence Moody's has that the sector stands behind the agency, the more bonds that are issued, the less credit work it will do each time. Pricing will depend on maturity and to a certain extent market conditions. At today's rates and today's market, having checked this morning, we think the 10-year bond today would be about 0.9% over the gilt, and at 45 years it'd be round about 125. Now they are tightening, so within the next month or two they could be substantially lower. Coronavirus has had an impact on the market, and for quite a long time, even though the gilt rate fell and has fallen very sharply in the last few months, the spread, that's the difference or the premium that lenders demand from borrowers, has increased. So these are slightly wider than they were when we did the Lancashire bond issue. As most of you will know, there is a Pwb consultation out regarding the rate. It does suggest there will be a reduction in the rate, but there are some big caveats to that. The consultation states quite boldly that any reduction would be subject to interest rates. Now, interest rates are much, much lower than they were in October, and the Treasury at that point justified some of the increase in the Pwb rate being that interest rates had fallen. If you look, they are significantly lower than a year ago. The timing is uncertain, if at all. Nobody knows what the government will do in this environment. It's got significant borrowing, a lot of uncertainty around its finances, and in the past it's shown no real appetite to give local authorities cheap or reasonably priced borrowing. The consultation events that are in the document are not taking place. That suggests either Treasury will need to make a decision without the consultation or delay taking that decision and reschedule the consultation. There may be conditions that are unpalatable or unworkable. For example, how do you tell the difference between regeneration for profit and regeneration just because it's a good thing? What happens with HRA developments that have an element of private sales or private rented to fund the development? There's a lot of detail that's missing. The other point we would make, if control is important to the Treasury and it's nervous about the agency taking borrowing away from it, aside from the fact the Treasury hasn't actually ever exerted that control, further UK BNBA bond issues can only increase the chances of a cut in the Pwb rate. If everyone backs off and waits and see what happens, Pwb rate may not be cut at all. My personal view is they won't cut it back to 80 basis points at the moment. They will do something, but probably in between the current rates. We've certainly seen very little indication other than the consultation documents that they're acknowledging just how large their margin is. We'll talk briefly about the other things the agency can offer. We can do forward rate loans. Now, some councils, Barnsley being one example, have had forward rate loans and taken them out fairly recently. What these generally do is guarantee the interest rate a council will pay on a loan that is drawn down within, say, 2 years. These have always been requested by the council through the agency back to 6 years ago when the business case was being written. They're used really when you need certainty about rates for complex projects, now particularly housing developments, regeneration, where you may have different phases with different revenue streams, and you may have to wait for income to come through. The costs are fully transparent. The agency is actually partnering with an investment bank because the agency cannot enter into the derivatives or loans, and they have to be back to back. Even if the agency had the mandate from you as shareholders, we don't have the capital to support a derivative, so we'll have to pass through to the council. Any loan with that kind of forward rate or structure has a derivative in it, it's embedded. So we're not taking risks, and the council wouldn't be taking risks like Hammersmith and Fulham did, but it's just part and parcel of councils borrowing these days. We're also setting up a short-term loan programme. These will be funded by commercial paper issues. Commercial paper are essentially bonds that are issued for maturity of less than 1 year. They allow a council to receive funding while a bond is ready or it waits for a different maturity. There's no need to commit to a long-term loan, although obviously the aim of the agency is that you do. We do recognise that sometimes local authorities just need short-term money, and the Pwb is not a viable source for that. We all know it won't lend for less than a year, and its rates are quite steep. Borrowers will remain subject to the agency's credit process. That's simply because the investors and the rating agencies are demanding it to give the agency a suitably high credit rating. However, you will not need to sign the framework agreement, which means you will not be entering into the proportional guarantee if you do that. These will be available probably from late June. This is highly dependent on the rating agencies doing the necessary work on the timescale we've asked them to. The lending timescales will be quite short. Initially, they'll be probably within 2 weeks. Over time, if you needed, say, 25 million, they'd be almost instant within 48 hours if market conditions were right. It's a very quick, flexible product. We also do floating rate debt as per the Lancashire bond issue. Very few councils actually have floating rate debt or variable rate debt within their portfolio. Although there's a certain amount of hindcasting in the last 10 years, given the way interest rates have gone, that may have been a mistake. Yes, they're uncertain, but interest rates have fallen, and if you look at the yield curves and the rates councils have paid on a fixed term rate, they could have saved money by issuing some variable rate debt. The interest rate again will be tied to SONIA. All new longer term bond issues have to be tied to SONIA for regulatory requirements. And at the moment, LIBOR will be phased out by next year. They've generally been proven to be cheaper than the Public Works Loan Board equivalent. The Pwb does offer variable rate debt, but it's extremely expensive because it prices off bank lending and re-lending of securities, which is not very transparent to say the least. It's ideal when you don't think interest rates are likely to rise. The current environment, I count the number of times I predicted interest rates will rise, let alone anybody else. So if you like, it does give you a certain degree of certainty that if you call it wrong, you benefit from rates not increasing. And the Treasury advisors themselves have consistently suggested debt portfolios have some variable rate debt. So this isn't the agency magicking something up. This is something we're doing in response to the advice that's been given to local authorities. We also offer standalone loans as per the Lancashire deal. These are all outside the proportional guarantee and the agency's credit process. The corollary of that is you would need an external credit rating for Moody's, Standard & Poor's or Fitch. That's because the market will need it. The council guarantees its own bond issue, essentially, and that's so that the ultimate lenders, the bondholders, get the benefits of things like the Local Government Act 2003, which gives them certain rights as lenders. They're available for any maturity, and there are various repayment structures available. For example, we could do an amortizing bond, we could do fixed or floating rate bonds of different maturities. It's totally up to the borrower. As long as we can price it at a rate they're happy with, we can almost certainly structure it. We'll come on to the big topic that we always get lots of questions about, which is the agency's proportional guarantee. The guarantee as it stands is a lot less onerous than the previous joint and several guarantee that the agency required. Although many of you are very comfortable with the joint and several guarantee, there are some councils who are not. Given that the agency is there supposed to be for all of local government, it was felt that that needed to change because it was too big an impediment to serving the whole sector. Borrowers will still need to guarantee all the back-to-back borrowing, but the liability under the guarantee will now be proportional to the share of the pool. So if you have 1% of the pool, your liability under the guarantee can only be 1% of the default amount. In the past, you had almost a liability that was almost uncapped as the book grew, because a lender could go to any single council for any or all of the amount. So we've significantly capped that. Importantly, it also means that if you owe nothing, you cannot be a guarantor, even if you repaid the loans early. In the past, if we'd issued a bond yesterday as the agency and you repaid your loan today, you would still have been guaranteeing the bond that was issued yesterday for its whole maturity. Now you'd only be guaranteeing it until today, which, given there'd be no payments due, no interest, no principal, you wouldn't be guaranteeing it. So there's a much more finite end to liability under the guarantee. There are some myths around the guarantee and the agency, to be honest, and we want to debunk them. The proportional guarantee does not cover the running costs of the agency. I know some others have suggested it does. It doesn't. It only covers bonds and lenders to the agency. It doesn't cover debts to anyone other than the agency, so you aren't guaranteeing somebody else's Pwb debt, which was inferred by at least one advisor. And you don't cover a default after you've repaid your loans. That's still been mooted by various people. It's a non-issue. Another point around default risk: no local authority has ever defaulted on a debt, and that goes back to 1067 when the Corporation of London received its charter. London Borough of Hammersmith did not default on a loan. What it defaulted on was interest rate swaps that it had been writing. Now, it had 2/3 of the UK swaps market at the time, so that was a significant control and regulatory failure of the banking system. So what the courts actually found was writing derivatives and not related to treasury management needs was illegal. Now, the local Legislation Act 2011 has changed that slightly, but it's important to note that Hammersmith and Fulham did not default on a loan. It was closer to what Nick Leeson had been doing than what any local authority has ever achieved. The agency is still retaining its credit process. It remains rigorous but light touch. We won't be doing what Moody's do, which is come in and camp in with a Section 151 officer and maybe the chief executive for a week. Local authorities publish a vast range of information, as you all well know, having to either write or approve the reports each year. So we basically use the stuff that's out there already, whether it's quarterly or monthly budgetary monitoring reports, statement of accounts, out-term reports. There's a swathe of information out there. The process is actually built on Moody's credit methodology primarily, simply because it publishes a very transparent scorecard that we can explain to you all how it works. There's no alchemy behind it where we're having to explain the computer says no. We can actually explain the method to you and what the issues are. The agency's board takes all the credit decisions, not us as managed service provider, it's the board. So all the decisions are taken there and they're accountable to you as shareholders. In general terms, the council needs to achieve a score of A or higher to borrow from the agency. That's probably one rating lower than it was in the past, but the UK itself as a sovereign rating is now rated AA. When the UK MBA set its credit threshold, the UK was still AAA rated. And no guarantee is given to any authority that will pass the process. There are some shareholders even now within the agency that I doubt will clear that credit process in the near future. Certainly not in my lifetime in one case, and that's just the way it is. It's not because they're doing something that's necessarily wrong. The agency is trying to exclude those that either present a disproportionate financial risk compared to other local authorities, or whose business model is sufficiently different that they present a very different kind of risk. So if you know of certain authorities that have significant commercial investments, they're generally considered by the agency to be a different type of risk than a normal local authority, so they may not make it through the credit process. Just to give a quick recap, because we've talked for a while and it gives you the chance to ask questions. We believe the agency's validated its business case. It always set out to deliver savings, and it has. We're readying the 3 bond issues. These will be pooled and we'll do whichever one is filled first, and then the others as demand fills those out. PWLB rate cuts are not certain and may not happen anytime soon. The agency is offering new products, and short-term loans will be available probably by the end of June. The proportional guarantee is less onerous than the joint and several guarantees, so there's far lower risk for any local authority around that guarantee. We've always said as an agency the risk of the guarantee was very low, but by changing the guarantee, it really is very minimal now. And the credit framework of the agency is still robust. We haven't really changed the credit thresholds, even allowing for the fact that most local authorities now are significantly lower rated than they were, simply because the UK is lower rated. That's just a fact of life, because the credit rating agencies operate a ceiling where a local authority cannot be rated higher than the sovereign. There's at least one or two of the shareholders that, all things being equal, would get a AAA rating, and they'd be capped at the moment. So we've not dropped our credit standards in response to a fall in the credit ratings. With that, I'll throw it open to questions for people.
Just to say, colleagues, you can type your question in the chat area of the webinar, or you can raise your hand if you would like to speak, and we will unmute. I can see one raised hand. Just bear with me. Nigel, you're unmuted now.
I don't think he is.
Hi all, can you hear me?
Yes.
Yep.
Hi, morning. I just want to know how the financial pressures obviously being placed on councils up and down the country right now are going to impact on bond issuance in the future. I know it's difficult to quantify, but obviously you outlined your credit rating criteria and said that there was a minimum of an A. Has that been diluted? Have you planned to dilute that, or will that always remain the same? And could someone just comment on those sorts of points?
We have no immediate plans to dilute the credit standing. We may have to if the UK sovereign is downgraded again, simply because if it was downgraded a couple more times, the UK itself would be on top of that single A rating. In terms of the situation local authorities find themselves in, there's 2 or 3 points around that that are relevant. One is short-term financial difficulty isn't the same as long-term default risk. So the agency will have to consider things like the maturity profile of the council's debt and the spending pressures upon it. Now, obviously, there are a greater number of local authorities in this environment that will not pass credit. Now, that's either because the agency doesn't believe they will, or more likely the council themselves believes that they will not and choose not to borrow at all, let alone from the agency. In my personal experience, most councils are actually quite conservative in their borrowing and will not borrow if they believe they cannot repay it. The third point as well is that we don't know what's going to happen in the next 6 months. There's a lot of uncertainty. So at any given point in time, the agency will come to a reasonable view of what's going on. Now, the agency has no incentive to gain the credit process because the markets will punish it. Either it won't be able to deliver the savings local authorities need, or a bond will default. And if a bond defaults in the short term, the agency's dead in the water. We all know that. That's just realistic. So the agency has, in this environment, will potentially have a smaller pool of people to lend to, but that will very much depend on the circumstances and who it is. I can think of a dozen off the top of my head that we wouldn't lend to right now under any circumstances. But beyond that, there's a grey area, and there are some that, yes, they may be struggling, but fundamentally they remain sound, particularly if the crisis starts to dissipate in the next 6 months. So it'll be very much
I think
a case-by-case basis.
It's also important to note that the credit process is confidential. So if someone wants to come to us to see if they fit within the credit criteria, we're glad to look at that, and it's something that would be between the agency and the council.
Two questions in the chat area as well. Would you like to read them because we're recording?
Yeah, I can't see them, Vitali.
Okay, I can
I
read
need
the
some
question
more
for you.
advice. Yeah.
How is, from Sharon Taylor at Stevenage, how is credit rating dealing with impact of COVID-19, which may not appear in published accounts?
The published accounts only form one part of the agency's credit rating process. Budget monitoring, papers to cabinet, and more importantly, discussions with the council, which forms part of the credit process, will inform that. If a council says it's significantly under pressure and may not be able to repay its debt, obviously the agency won't lend. Within the grey area, the agency will come to review with the Section 151 officer. Both the agency and the Section 151 officer sign the credit assessment to say it's fair and reasonably accurate. That's the best we can do in this environment, really, is to be honest with each other. Again, there's no point in the agency lowering its standards. So the agency will come to review about what's likely to happen and whether a council, whether it believes it will be in difficulty or not, will actually get through any difficulty thrown upon it. We have actually been dealing with this for years because of austerity. It's been a continual process of looking to see which authorities may be in difficulty, which won't. I think this is a headache we can safely agree that no one had ever thought about in realistic terms. But we're fairly confident longer term local authorities will get through it.
Christian, can I just go back to June's point about and your answer on confidentiality, and just compared to a local authority looking at another form of borrowing, not PWLB, going to Moody's or Fitch's or S&P, that you can't enter that process and not come out with a public declaration of what your financial position is. Is that? I think I'm right in that, aren't I? Whilst with us, you can, we can look at you and we can give you a confidential view on whether you should be proceeding into one of our bond issues. You go to the rating agencies. It's going to be, you can't do that confidentially.
You could only do that confidentially if you're doing some kind of bilateral arrangement where both parties agree to keep it private. And Moody's and S&P always reserve the right to publish that credit assessment if they believe it's in the public interest. So you're right for most forms of the alternative, they're realistic. Certainly anything that requires more than one bank, such as a bank loan, potentially that's a public document. The only exceptions would really be purely private arrangements, for example, certain project finance transactions. And even then, the rating agencies can publish them, particularly if you withdraw the rating because you think it's going to be adverse. They invariably publish it in that situation.
Thank you. Can I, Adrian, could you just say, I don't think there are any more questions immediately, but could you just say something about the bond market that you're very active in day by day and your the other side of your professional life, just so that those joining us can understand a bit more about the overall position?
Thank you, Merrick. The market clearly was very disturbed by the early stages of the COVID-19 lockdown, and for a period of time, really there was no new issue activity available. That lasted for about a month. Since then, the spreads over gilts have been coming in progressively, but with a particular emphasis on quasi-government and utility-like borrowers. So we have, for instance, watched a major burst of activity on utilities and on housing associations coming into the markets, generally with slightly lower ratings than local authority borrowers or the UK MBA, and their prices have shrunk from somewhere in the order of 170 to 180 over the gilt, down to 135, which is where they're sitting today. All of those deals have been very heavily oversubscribed. The institutional investor market is very long of cash at the moment, and it is very nervous about putting that cash into the corporate sector and particularly the lower rated corporate sector, because it's worried about credit risk. It is very keen to invest in anything that has a feel of credit certainty to it, as local authorities would have. So I think this is a very attractive time to issue. It's obviously difficult ahead of going to the market to know precisely what the pricing is, but it is clear that the pricing is substantially inside where the PWLB is today.
I can see Stephen has raised his hand as well.
Okay, thanks, Vitaly. First point I'd like to make is just to thank Christian for the presentation, which I found incredibly helpful. Having been involved with the agency from the beginning and trying to explain to very conservative directors of finance and elected members what the agency was about, and that we got a product they could be comfortable with. I think that today has shown that is now the position we're in. So I think that's incredibly helpful. And I think we need to get this out, not just to the panelists today and to the people in attendance, but to the wider local government sector. Because I think what we have now is something we can really get out there and make the most of. And the way Christian's done it today, get it to lay people like myself, elected members and others, to get them into the right place. So it's a comment rather than a question, but it gives me much more confidence about the way forward than we've had over the last couple of years.
There's another question in the chat area. Yeah, sorry. There's a question from Matthew Bunyan at Hatsmere. Have you seen an increased interest in UK MBA from LAs since the PWLB rate increased?
Yeah, yes, is the glib answer to that. I think most of it really happened once we did the Lancashire bond issue and we proved the savings. There were plenty of people that would talk to us, but they were watching to see what happened with the agency's first bond. The first bond's done, so we've proven we can deliver significant bond savings. Now, there's been talk about the fact it was Lancashire rather than the pool. The market itself on two counts. One is generally a lot of the investors, including Aberdeen Standard, would actually prefer the pool rather than a single council because that diversifies their risk. And the second point around it as well is that where investors themselves are agnostic about whether it's a pool or a single bond, they just look at the credit rating. And Lancashire's credit rating at the moment would be the same as the agency's will be once it's published. So in terms of delivery, we're fairly confident that there's no difference between a pool bond and the Lancashire bond. And that's the message we're sending out to people. If you are interested, Lancashire is a very good yardstick for the agency in its delivery, and we are talking to a much wider pool of councils now that can see the savings are there. We can only wait to see, given some councils are finding it very difficult to take decisions, how quickly they can approve the framework agreement, but hopefully that problem will start to ease in the next few weeks.
But of course there are a significant number have already historically approved the framework agreement, haven't they, Christian? There may be an amendment they have to make to it, but they've gone through their appropriate processes, some of which have involved full council agreement and others under delegated powers.
Yeah, 25 is the number we've always had, but some local authorities never even told us they approved the framework agreement. We found some of those out just looking at the website through their cabinet papers and things. So there may actually be more than that. This version of the framework agreement is almost the same, but the terms and conditions around things like the guarantee are less onerous. So we're fairly comfortable that most of those authorities, because they sought delegated authority, can just transition to the new framework agreement. We should have the approval templates and things up within the next 48 hours. We are, particularly in reference to Sharon's question, just adjusting them in light of the current conditions that local authorities are in, just to make it clear where the risks lie and when they fall. So it's nobody is misled around the risks. They remain very low, but it's just to address some of those questions.
Thank you, Sharon, for your subsequent comment online. We've also had from John Illingworth. You're going to send the presentation to everyone, aren't you, Christian? So if anybody either got IT problems as John had, or further questions, and please feed those in. There's a question here from Hartsmere. Is there a minimum level of borrowing for individual local authority, Christian?
Not as such. We would advise you, given the time you would need of members' time in this environment, that if you were looking for less than £1 million, you probably shouldn't, simply because you'd use that time up, but there is no minimum. In fact, our ideal situation is if every council were to come in for 1 million or 343 of the English principal authorities. It isn't going to happen. But from our perspective, the more the merrier, frankly.
Right, there's also a question about funding possibly for police and fire in the near future. We can only lend to local authorities, principal authorities that have the power of general competence. But of course, local authorities can lend on to others. So, that might be a mechanism. You, Christian, I think, and June, you've had a lot of approaches from drainage boards and others.
Yes.
You just want to say something about that?
Yeah, as Sir Merrick said, the general power of competence is key, which if you go straight to council without nuancing the question, will be the 343 principal authorities, 2 of the combined authorities, which aren't generally the 2 that you think. They're actually Cambridge and Peterborough, and I think Tyne Tees. 2 of the combined authorities have what they call a functional power of competence, so that needs a legal opinion. MHCLG actually believe the county fire services have the general power of competence, so they may be able to borrow, but we would need a council's opinion to address that. At the moment, police crime commissioners, police forces don't have a standalone power to give a guarantee. Now, we know of situations where they have given a guarantee, but the issue, as it always has been with them, is whether they're found to be various or not if they're called upon. So we would be very reluctant to lend directly to fire and police authorities when we can see no prospect of them actually having a various decision over the guarantee. But we are very happy for authorities to borrow and lend on to them, and we would take that into account in the credit process, that the money's been on lent to another authority. That's a double-edged sword, because on the one hand we wouldn't count it necessarily against the local authority's own credit rating, but we would look beyond to the police or fire authority to check that they're good for the money. So we've got no objection to that, but it's something we're going to have to address with the council's opinion at some point.
Okay, I mean, there's no shortage of uncertainty of life generally, but for local governments at the moment. But one of the elements, of course, is the Pwb consultation. And Sarah, I don't know whether you would like to say something just on that. The LGA's going through its processes to formally respond to that, and I think part of that does refer to maybe an extension to the consultation.
Yeah. So I think that the government is currently considering whether to extend the consultation and whether to put in place some of the regional or other means of consultation around the country. The LGA certainly will, is seeking better PWLB rates for councils. I don't see a contradiction between that and being a party to the UK MBA. I think one of, as Christian said, the aim is to get to beat the PWLB, to get a better rate for councils by working together, by the sector for the sector, and that will continue to be the ambition. If the rate does come down, well, that will be good, but there's no reason to assume that the UK MBA couldn't achieve the same or less. It's also, I think, likely that it will come down. We know it will come down for certain types of borrowing, but perhaps not for all. The other point I think about the agency is that diversification of your sources of borrowing is one of the key benefits, and this uncertainty about what happens in the future with the PWLB means that having a different vehicle available is really important. So even if you could borrow it from one or the other, is it not better to have a route available for the future for everybody? Because we don't know what the Treasury will do with the PWLB as we go forward. We think that there is a role for the UK MBA. I think, Merrick, our ambition is probably no more than to take 25% of the market of borrowing. That's quite ambitious, but we're not there to take over from the PWLB, but it's an alternative route for councils, and we still think it's valid despite the proposals in the consultation.
And as we've been saying elsewhere, there are enough calls on Treasury at the moment for funding for just to continue the life of this country. And if actually the market, the capital markets take on some of that burden, I would have thought, that's a good thing for everyone. We know the appetite of the markets, Christian's referred to that, is extremely positive at the moment, and I think that's a good message if some local authority capital borrowing was handled in that way rather than drawing on inevitably limited resources from Treasury. And of course, holding out for sort of jam tomorrow, none of us know what the result of that consultation will be, because when it started, we weren't in the world we're in now, let alone everything else. So the fact is, the first Lancashire issue, we undercut PWLB pre its increase last October. So that was, and Christian's updated that in his presentation of where that actually stands today, which is extremely positively. So we know the demand's there. Our plans are clear on the suite of bonds we'd like to go with, but we do need to get our members, particularly shareholders, to participate certainly in that first pooled issue. I don't know, have we got any questions, or points that anybody wants to make? If you can raise your hand. Or let's see any at the moment. I think it might just be so you've heard from Christian, June, who are operating that side of the MBA. Clearly, the LGA provided great support throughout, and we have a service level agreement with them to do the other side of our activities, the administration, and so on and so forth. We haven't. You've seen the historic balance sheet, which is tells you really very little apart from the historic position. I think it's just worth saying that as part of that first Lancashire deal, and great thanks to Lancashire for their consistent support, and now in action as well as words, they agreed that they would roll up our 5-year fees and pay those at the time the bond was done, and that happened within a matter of days. So that has given us a significant amount of revenue in one fell swoop, and that puts us in a reasonable position at the moment. But we have got to keep on issuing bonds because we won't have a similar sort of arrangement in future. We'll simply be getting our income will be coming on a regular basis through the length, a lifetime of each bond. So at the moment we are solvent and meeting our liabilities, but we need to issue more bonds to build the business. Don't know if any directors want to say anything. We've got a fine board with lots of experience of local government and the wider world. So I don't know if anybody wants to chip in. Silence. June, you're the other side of the Atlantic.
That's correct.
But that's not stopping you at all. Anything you want to just add from the PFM world of
Yes.
municipal lending stateside?
Yeah, I would definitely say, certainly we've brought our experience from being quite active in the municipal market in the U.S., which, we're having similar, if actually not worse, local government stress here. But, through it all, the capital markets have, continued to support local government. Quite frankly, as Adrian's spoken, they actually, in these times of stress, see local government as being a better bet than the corporate world in many ways. I did want to say that we were very heartened by the response of the capital markets to the Lancashire transaction, where we had 26 different investors put in bids. We had one or two which were for the whole transaction. And what we did in marketing that was really meet face to face with a number of investors who voiced their support for the sector and really were looking for, longer, more pooled transactions. So I think there is a very eager investment base out there who would like to support the sector. So we look forward to bringing them, hopefully more opportunities to invest in local government.
And just on that memorable morning when we'd taken a slightly more positive overnight position and opened for trade, literally, and then everything was going south fast. You were open the window for really just a couple of hours, wasn't it? And
2 hours.
And
yeah,
and closed, and at that point we were already twice oversubscribed, and had we kept the window open, it might well have been more, but we didn't need that. We were in a comfortable position at a good price.
Mm-hmm. Yeah, but we have had subsequent, interestingly enough, I think one of the questions was, have we heard from more local authorities? Yes, we have. But we've also heard from more investors who are actually cold calling us, wanting to know when the next deal's coming. So I think there's lots of interest on both sides, and we encourage local authorities to come forward.
Okay, I think we've got Paul Forrester. I don't know if you can be heard now. Paul, you raised your hand.
Hi there. It's just a question really, I guess, in terms of practicality around the pooling and understanding kind of commitments to the certain buckets and kind of the gaps that are required in order to reach the 200 to 250 sort of thresholds, and how, if that's going to be communicated or if that's kind of kept confidential, and just understanding that as a process.
Christian, do you want to?
It'll actually be quite open. We'll be making it very clear to other potential borrowers who else is looking to participate in the bond and timescales, because we need to get people to agree both on timing and the specific maturity. Now, at the moment, our discussions with most of the people who have shown interest is they're actually reasonably flexible within a few years, simply because they're looking at the CFR and saying, I need to borrow round about this maturity. I can't think of anybody who's approached the agency that's tied to a specific date at the moment and a specific maturity in terms of it has to be 22 years, for example, 22 and a half. So it'll be fairly transparent. It's important to remember that actually every bond the agency issue with the proportional guarantees pooled. So it's not just a number of, say, the 5 authorities that are in a bond with you on the first one. It's actually that group of authorities, then the group that come in on the next bond, and the next group that come in on the next bond. So the timing wise, it's a case of getting people to agree. Now, I know local government, certainly in the UK, unlike Scandinavia, generally hasn't discussed their plans with each other and coordinated them. But obviously, within the various treasurers' societies, the county level meetings, London councils, finance directors and their staff and treasury staff talk to each other all the time. So we would be very surprised if we found it difficult to get people to agree on a maturity and the timing of a bond. The only thing we will always ask is just prior to launching, we will ask you to commit, because obviously we can't place a £250 million bond and then 2 days later have somebody go, well, I don't need the 50 million I wanted. That's simply because what can we do with it as an agency? We're stuck then. So to quite late in the process, you do have the right to back out. But we don't anticipate coordination being a significant problem. And over time, the more bonds the agency issues, the more maturities it will be able to offer local authorities, because it can always issue more of a bond. It's called a tap. So the more people who borrow and the more frequently they borrow, the more flexible over time the agency becomes. If you are desperate for money now, then come the end of June, hopefully we'll be able to give you the money on a short-term basis anyway. Say, for example, 3 months or 6 months.
And I think one of the things with that is that, so let's say we've got a great deal of interest at 10 and a great deal of interest at 45, but someone needs 25-year money. As Christian said, what we can do is that we can lend on a short-term variable rate basis for that period until we build up to the 250 for the 25 years. So if you did need the money, we could get it to you as we're building the interest in that particular maturity. So there isn't the idea that everyone has to move at the same time. We actually can lend on that basis.
Right. I think probably it's a sort of last call for questions or points that that anybody wants to make. So now's your opportunity, please. If you could raise a hand if there's anything you want clarified at this point. We are, operating as whatever normal is. We issued the first Lancashire bond during lockdown. It's doable. We can move quickly. As Christian's indicated, that requires local authorities to move quickly, of course, and to be coordinated where approvals are needed and so on. But we've heard about the market. We've heard the demand is there. We believe the prices are good, and we know the question mark against PWLB and other alternatives. So we hope that we will get the group together at least for the first issue. We may well be doing a single issue local authority, named local authority around the same time as well. We'll see how that develops, but the pooling is the key issue for us at this precise moment. So, Natalia, unless I'm missing any raised hands.
I'll just unmute Andrew Pate in case he's got any questions.
Oh yeah, okay.
No questions.
All right, hold on. Yeah, John Illingworth saying it's been recorded. Will I be able to watch back and pick up what I've missed? Yes, John lost his IT. It's being recorded. What's happening with it? Perhaps we should have warned everyone it was being recorded for.
Yeah, yes, I did say at the beginning.
You did, okay.
Yeah.
I missed it. Okay. So are people going to be able to access that recording?
Yes, we will share the recording with all shareholders.
Okay. Good. I think we're probably there, everyone. If unless somebody last minute indicates. If not, thank you very much. I think we had audio conference calls at the beginning of, well, just before lockdown. started with a reasonable number of authorities on the line. I think we should continue this model without the AGM at the front of it, and hopefully that will be of use as we go along. We keep shareholders up to date, but please do not hesitate to speak to Christian and June. Just Christian, you might just want to, when I finish in a second, just read out your email and your phone number, so that there's an easy way for people to get hold of you at any point. But we'd welcome that. So thank you, everyone. Christian, do you just want to do that now?
Yeah, phone numbers first. It's my mobile, which is easiest, which is 07974 355 034. I'll just repeat that. It's 07974 355 034. And the email to contact me on is christian.wall, that is W for whiskey, A for alpha, Lima L, and that's at ukmba.org. If you need to look it up, both mine and June's contact details are on the website. Also, Vitali's company secretary. If for any reason you can't get hold of me or June, you can usually get hold of Vitali, and again, his details are on the website.
So in closing, I think I'd just thank you all for taking part today. Thank you to your board, who have been steadfast and consistent right the way through, and true believers in what we all set out to do a few years ago now, and stuck with it, as have others. Support of the LGA has been outstanding, and the view our shareholders, and we thank you for continuing to believe that the time will come, even though it took longer than any of us would have hoped. It has come. We've approved the concept, which was something we were aiming to do, certainly as a single issue, and we look forward to moving to a pooled issue shortly. And I think this through difficult times, there's a real role for us. Sarah's absolutely right. We're not trying to usurp PWLB, but there's a role for us. We are not the lenders of last resort, so we're never going to lend if authorities can't get a lending from PWLB in principle. But there is a role for us, and I think for local government to have choice and not to be reliant on a single source or some very complicated deals that are out there that are hardly transparent. We are very opposite of that. We're open and clear and vanilla and simple in really in what we're offering. And I think this is a time for all those attributes. So thank you to everyone, and I wish you well in your prime activities in local government, and thank you very much. And thank you to our technology gurus who have kept the process working very well. So signing off now. Thank you.
Thank you.